Hi, everybody. Jared and Chris here with Beyond Capital. Good to see you all. We have inflation numbers this week. That has been a big market mover all year long. Let's see what that and the Fed has in store for us coming up.
It will be no different this week, Jared. All fireworks and all eyes on Thursday. We keep saying this almost every week. There's something with the Fed. There's something with CPI or inflation. There's something with something. Every week it's like the market's going to be here or it's going to be here. We have to wait and see. And that has literally been how we've had to position for everything. So stick around. You don't want to miss this video. It's a preview to inflation numbers and a big kickoff for Q4.
Okay, guys, welcome back. Let's have a look at some of the charts. Let's see what is, what we're expecting, what the CPI news might have for us, the inflation numbers, right? Now, inflation has been a major topic this year. First of all, everybody is talking about inflation. Everybody is feeling inflation. Are you feeling inflation, Chris? Is it inflating you a little bit?
I have put on 20 pounds of inflation.
And it's all in the midsection here.
It is very bloaty.
Yes, we're feeling it. We're feeling it.
I was looking at some used cars this weekend, and I noticed there's a lot of people that are trying to sell SUVs and trucks. Is it something to do with the less than 20 miles a gallon? Is it something to do with the gas prices at $4 plus that Americans are hating right now? Your thoughts, because I know you're kind of in a similar situation.
Just because I have two SUVs that collectively together don't get 20 miles a gallon.
That's right.
So yeah, there's lots of gas guzzlers for sale. We have seen gas prices going up. We'll talk a little bit more about that. Yeah, that was pretty fast. I think I saw our cheap gas around here is Costco. I think that's cheap gas for everybody. I saw that at $3.99 not too long ago, and that lasted for about 10 minutes. And then it's right back up.
It felt like a couple of weeks.
Yeah, I would say gas prices screamed back into this is not okay territory really quickly. And I think there's a lot to say about that. Before we get into oil prices, energy costs, all that, as far as how that impacts inflation and some of those numbers, it's interesting to note, I was reading some super cool statistics over the weekend. I love nerding out on some of this stuff. And the 9 worst trading days of this entire year, according to the S&P, of the 9 worst trading days, 7 of them were around inflation or the Fed.
Yep.
And that's so the market is very focused on that. Only 2 trading days had to do with worse than expected earnings on major companies.
So your Facebook, Netflix, when they just smashed it down like 40% and dragged everything with it type thing?
Yeah. And remember Walmart had that real surprise, inventory.
Target, Walmart was bad, inventory glut. Yep, exactly.
Yep. So most of the reaction in the market to the downside, the worst stuff has been inflation related, Fed related, interest rate related. So the market really doesn't seem to be super worried, at least at this point, about earnings. Now that could change, and we'll talk about that a little bit more. But it's been very much focused on inflation and Fed and so on. Now, on that note, we do have earnings coming up. This is earnings season, so most, if you look at your, favorite stocks that you're holding or charts or whatever, we have earnings, this week, next week, the week after. Earnings is kind of what's keeping everything in place. We're kind of sitting at this $220 a share S&P type situation, and if we get below that by much, we're gonna start to feel the pinch on that. So I think that's what's holding everything up for now. Companies are fairly robust. Everybody has cash. Earnings have been pretty decent. If we start to see those earnings going down significantly, that might be the final leg lower. That might be what everybody has been waiting for. You've got the Michael Burrys out there saying we're halfway through this crash, and if earnings come out terrible, that could be the second half of it all.
I think earlier in the year, the phrase getting tossed around was the Fed pivot. I think that's no longer a thing. I think the Fed isn't pivoting to cutting rates. I think the Fed is potentially pausing. That's probably the best case scenario for the markets to get a relief rally. The Fed's going to have to basically allow the market to price in the peak Fed funds rate. And another thing that we've been watching really closely, the 5 and 10 year treasury yields, the 2 year treasury yields. We're in one of the deepest inverted yield curves we've seen in a long time. A bottom in equities in a rally probably has to be a top in the Fed funds rate, a
Yep.
top on the 5 and 10 year treasury yields, and probably a top on the 2 year as well. Without those topping out, without the dollar topping out, I don't think we're going to see a decent rally in equities at all. And so with earnings season, the dollar's getting all the safe haven bids right now. It's been that way for 14 months. It's been ridiculous on the dollar to get this type of strength and appreciate this quickly. But here we are. Path of least resistance is dollar strength and safe haven in the dollar. We're looking at all sorts of stuff. We're looking at currencies like crazy. There's wild stuff in currencies. But again, people are trying to forecast and predict where's the bottom. Where's the bottom in the stock market? I mean, right now, I think it's going to be a correlated bottom. You have to see certain things top out, bottom out in order for the market to kind of unanimously to have that broader recovery. So that's not here. That's the point, is like we're not there yet. And so I think rather than trying to call the top or call the bottom, you just have to be protected. I know you and I are not actively taking on stock, right? We're not actively buying positions. We are actively in options because we can maneuver our positions, but we're not actually taking on stock. We're not ready to dump cash in the markets right now, which I think is keeping us, on the sidelines, but actively on the sidelines. We're ready, Jared. Like, we want to get subbed in. We're looking at the coach like, come on, man, I'm ready.
I think the Fed situation is super important. I think you're right. Pivot. There was a lot of pivot talk. I think that's out of the vernacular for the moment, and it's all about pause, right?
Yep.
And so looking for that pause, seeing when things pull back. And so I think that's what the market's looking for. Sentiment is so bad. Everyone is so just beat down and out of the market and everything, right? We're not used to these higher volatility markets. And so there's just been a steamrolling situation that has gone on. And now it's, all eyes on the Fed. But at the same time, if 7 of the last 9 worst trading days this year were basically Fed or inflation related, I think there's also going to be an element that the market is less and less following that, right? There's almost like a numbness that comes about it. Everything has a news cycle, everything has an attention span, and yes, the Fed is ruling the roost right now. But if the market is so hung on everything the Fed is saying, there's going to be a point where the Fed will run out of that jawboning ability, and interest rates will function, and things will be okay. So that's kind of what we're looking for.
Yeah, well, we've been beat up enough with it that I'm certainly desensitized to it, because I literally have to pay attention to it every week. So at some point, I'm ready for the market to get on this pause, start to be a 6 to 8 month forward thinking discount mechanism. All these things are like, these are the correlations we typically look for. And enough, man. Like, the Fed has had its run. I can't believe how every month it's like they are the most dominant force in the market, and everybody, hangs on their every word. It's like, we know what they're going to say. Since Jackson Hole in August, we know what they're going to say. They're not changing their tune at all. So like you said, the jawboning has been very strong. At some point, the jawboning has less effect. And then from there, I think the market, let's transition this into energy. You and I talked about this last week. I really think that energy, because of a very intentional decision for OPEC and OPEC Plus to cut production by 2 million barrels. We saw a massive surge in oil. We went from $76 lows to $90+ in like 2 weeks. So the Fed can talk all they want, they can jawbone all they want, but they cannot stop energy prices, and they can't stop energy-related inflation. Europe is in a pickle right now. The U.S. is in a pickle right now. It's like, clearly there is a bigger, stickier inflation monster out there that the Fed cannot tame. And we clearly saw that. I mean, throwing the U.S. a bone a couple months ago, saying, sure, we'll increase production by 100,000 barrels, which is 0.1%. Nothing. Cut production by 2 million barrels, and oil prices go nuts. And energy, I mean, Jared, you watched our energy stocks go crazy for a couple of weeks and to the upside. So again, we were positioned for that, and we still like that play. I mean, XLE in the energy sector is year to date the best performing sector by far. It's up like 47% for the year. Everything else is in red. So, I mean, that's still where the money's being treated best. That's right now the best hedge against inflation. And the Fed can't raise rates to squash it. I mean, unless they want to raise rates to ungodly levels like 8 to 10%, and we have a 1980s, 70s, 80s scenario again. But I think the Fed is kind of capped at that 4.5%. I think the market is sensing it. And so last week felt like this is a game of chicken. This is jawboning Fed. This is OPEC, and they are like a movable object, unstoppable force. And somebody's going to swerve. And I don't think it's OPEC. I think it's the
Yeah.
U.S. I think
Oh,
that's the Fed pause we're talking about.
yeah. And OPEC has they have no incentive to do
True.
anything other than they're doing. They're keeping oil prices high, and that works great for all the OPEC countries
Yep.
and all the oil producers. So that's good. We're in a situation where, I mean, I think OPEC and many of the major producers have said multiple times to all these countries in the U.S. The U.S. was energy independent 2 years ago, right?
Mm-hmm.
And they're saying it's not our fault that you guys decided to turn off the spigot. So
True.
we don't really care what you want, U.S. We
Yeah.
control the oil, and oil's in major demand, and I don't blame them. I think they're not here to clean up our policy mishaps. And
True.
so at this point, the Fed went from we want to raise rates to tame inflation to we want to raise rates to hopefully control energy prices. And now I think they've even taken it a step further of we want to raise rates and start seeing unemployment, right?
Yeah.
I think
Yeah.
I think
That
that's
was
safe
as
to
of
say
last week. Yep.
is that they want to start to see a real the Fed is trying to cause a recession, and they're
Mm-hmm.
actually having a hard time doing it, which is kind of weird. And
Right.
you have at the same time we have on the other side the World Bank, the UN has reached out to the Fed and some of these other central banks and said you guys are going to cause
Stop raising rates.
a massive global problem. Like you have to
Yep.
slow the rate hikes down, and the Fed's over here going, we're going to stand tough. The Fed is like, what would be the best analogy here? They're trying to cure, an illness by, painting a picture. It's they're two completely unrelated scenarios here.
Common sense wise, this is too late. I mean, they didn't acknowledge inflation until it was 6 months into it when it was really bad. And then they tried to use the word transitory. That was the wrong word. Then they eliminated it. Then the market finally grabbed onto the fact that, okay, it is inflation. It is really bad. And so we're in this weird, like 3, 4, 6 month cycle where the Fed is just super reactionary and late to what really makes sense. And so they're
Yeah,
almost overstepping the necessary boundaries of like if they're trying to raise rates and try to tighten. I mean, you have to remember the whole world a decade ago was at 0% interest rates. So at some point you have to, normalize interest rates and go back to something that
yeah,
can exist. The saying is the Fed likes to pull away the punch bowl right when the party's getting started. It's like we just came out of a COVID recovery, and again, engineered. I think that you and I have called this the kind of the great reset and the great reality, and it's probably what it's going to be. But if it gets worse, I'm very curious what the names are going to be thrown around. If we see another, 20-30% lower, if Michael Burry is right, for example, his, this is the 50% of it, it's not even halfway there. What does that look like? Because that in a lot of instances would be as bad, if not worse, than 2008. And so how do we get there other than pointing fingers at the Fed? It's a really odd situation that we would be in if it does get that much worse. I don't know who else would really take the blame other than the Fed.
I would say in Olympic terms, this is a high degree of difficulty, and we may not stick this. So
Yep.
this
We
could
already have
be
a broken ankle. This is Kerry Strug. Kerry Strug
That's
highlights.
right. That's right. So on a positive note, though, let's give it a positive spin for 2 seconds here.
That's right.
Dow Jones average monthly gains. This is a seasonality chart here since 1998, right? We are in Q4 as of the
Mhm.
last week and a half, and October, November, December Q4 gains are some of the best, most consistently best over the last, pretty good chunk of time, 20
Sure.
20 plus years. So we've had nothing but terrible sentiment and massively underperformance this entire year. Now, you and I have been talking about the fact that when we have first halves of the year like we had that are so bearish and so down, the second
Mhm.
half is, historically speaking, always some sort of an improvement, right?
Yes.
There's been little to no, I don't think there's been any worse second halves than a first half when we've seen what we've seen.
Correct.
So it's interesting that Q4 here, since the last 20 plus years, we've seen pretty consistent gains for this month, next month, December, and so on. Now, even if it's possible things could get terrible, we could see bad earnings, and that could just be the last leg lower, and that could give us maybe an amazing Q1 of next year. But if earnings
For
hang
sure.
in there, I think we have a chance of seeing this carry on. I think we could see a really good Q4 across the board. Now, we've been pretty vocal about the fact that we're very interested. I mean, I'm specifically super interested in energy and materials. I think the steel play, I think aluminum, I think energy, copper, I think these are all so very solid to be kind of focused on going into the end of this. So I like that. I think there's some good opportunity there. And I continue to kind of position my own portfolio in that direction. And as you mentioned, we're really staying on the option side of things. I don't want to get heavy stock right now because if we do see one more flush lower across the market, limited risk with the possibility of owning some shares on that next dip lower is kind of where I want to be positioned. And I know you're on the same boat with that, right?
Yeah, same way. And just to make a note for that graph too, Dow Jones, S&P is likely outperforming that for Q4. Nasdaq likely outperforming that for Q4. The last 20 years, the Nasdaq has been the top performing index, and Q4 has been an impressive rally. We can give a quick shout out to our friends at Market Huddle who had an awesome guest this weekend, Paul Craig, who was talking about knowing his managers that have made their entire careers trading Q4 only, or Q4 has
Yeah.
been their major focus when they've been the most aggressive. And so I just did the numbers there, Jared. You have a running average for Q4 of 1.74% a month. And we might have like a slightly slow start for October because we do have inflation numbers coming again. We do have a rate decision November 2nd. We do have a midterm election for the US. Maybe we have this very like subdued, delayed Q4, but let's say mid November to the end of the year, we could have just one of the more ridiculous rallies or squeezes just because there's money to be reallocated and releveraged. And maybe that's like the very, very end of 2022, but into a really strong like January, Q1 of next year. So I think the market is wanting so badly just to rip on something, right? It's
Yep.
just been beat up
I
so
agree.
badly. It's like it's ready to rip. It's just when. And so the timing is tough, but options are great to stay attached and stay active, but not overcommitted. Because just like you said, if the SPY goes to 340, really interested. If the SPY capitulates lower than that, I'm going to be buying pretty aggressively, looking for an aggressive, healthy snapback. Q, same thing. Dow, same thing. But I think the S&P and the Qs will probably perform better. Yeah,
And
I
and
just
and, and on that note, I think one thing for everybody to be keeping an eye on is S&P, Nasdaq, Dow is going to be the thing to watch. But I think that we have seen certainly a major disconnect this year. We saw it kind of latter half of last year as well. I think sectors will be the big thing. I
yes,
could see the S&P not rallying and certain sectors going crazy. We've talked about material. I
yeah.
love material. I love energy. I think energy has tons of potential to go higher. I think material has a lot of potential to go higher, while the S&P maybe doesn't do much.
Tech
Right?
doesn't do much. I think you'll have your mega caps, right? Your large cap tech will do fine. They'll stabilize, but they're not necessarily going to jump to new highs anytime soon. I think would I park money in Apple and Amazon and the Googles, and yeah, I would park money in there and dollar cost average in forever, but not get overly positioned because maybe they're only good for like a 5 or 10% bounce. Maybe they're so correlated with the overall market that let's say the S&P bounces double digits, 10-15% by the end of the year, just to get above the lows from June and above the lows we had in September and in October. Energy most likely will be the highest volatile sector, in my opinion. I think that this is still an inflation trade. All the gains were lost essentially from June. Like it was a great
Yeah.
Q1, and then April's like started to kind of dent, and then June just flushed everything. And so it was like a huge reset back in June.
What a great chart to say. This is where everybody thought. We had oil all the way up at 130. This is crude oil. This is just oil futures right here. And we had it all the
Mm-hmm.
way up at 130, and it basically went down 50%, just shy of
Yep.
50%. That's a 41% decline. And this is right where we start to see Fed or sorry, where we start to see OPEC. Putting the pressure on and so on. And here we have oil up 21% in the last, basically the last 2 weeks. So
Right.
this is a great opportunity. You know, this was a great time to wash out all of the oil bulls. If you were an energy bull at 120, 125, 130, even at 115, right on that next bump up there, you've been washed out of the market. And
Hmm.
now it's time for that rally, I think, to continue on. So I love pretty much anything energy, I would say, at this point for the immediate. And then I think material has I'm really looking at material kind of Q1, Q2 of next year. I think energy is a pretty safe bet for
Yeah.
Q4 of this year. So that's kind of where I'm positioning myself. But that's our take. I think it's going to be Fed, it's going to be inflation, but at some point, the sentiment is only so bad and can only get so bad before buyers have to start stepping in. So let's see how earnings goes over the next 1, 2, 3 weeks.
Hmm.
And if we have even some remotely decent earnings, I think we have a rock solid Q4, and I think we see a big rally in Q4. So
I feel like the throttle's ready.
let's
Get
go.
ready,
We're,
man.
we're revving the engine. We're ready to rock and roll. So
That's right.
if you guys have any questions, comments, just leave a comment under this video. We'll get back to you. We'll respond, and we'd love to hear what you guys are looking at, watching, following, and thinking about as well. So thanks, everybody.
Bye.